There's really only two scenarios for the stock market in 2024, up or down. And with your money and your retirement on the line this election year, you need to learn about what's next for the stock market and how to prepare for either scenario. Before I show you how to invest in 2024, we need to learn how the market usually performs. You might know that the stock market returns on average 8%, 10%, or some people might even say 12% as a stock market average return. The problem is the stock market almost never actually gets the average return. Since 2000, the S&P 500 has averaged 9 percentage points. Except it never gave you a 9% return during a full year. It came close in 2004 and 2016, which were coincidentally two presidential election years. It returned 11% and 12%. But in 22 out of the 24 times the stock market that returned an average of 9% finished the year nowhere close to 9%. Generally speaking, the market is either up big or down big. Now, there have been 6 negative years since 2000 that have averaged a return of negative 17%. There have been 18 positive years since 2000 that average return of positive 17%. If someone asks you what you think the stock market will do this year, you should probably tell them 17%. You just don't know if it will be a negative or positive 17%. I'm Mr. Retirement, and I want you to get more interest, pay less in taxes, and avoid big retirement mistakes. Subscribe to my channel, Mr. Retirement, so you can stay up to date with all the latest news on how to get the most out of your retirement. Now, if you're trying to predict what's going to happen in the stock market in 2024, you've learned already that the stock market is probably not going to give you that average return. Since 2000, the market was negative 25% of the time and positive 75% of the time. I broke down these positives and negatives actually into 3 different categories to see what we could learn and apply to our investments in 2024. There's negative big, there's positive big, and there's nothing to write home about. When you break it down into those 3 categories, 5 times out of 24, the S&P 500 lost 20% on average. When you look at the times where the S&P 500 didn't do much at all, it averaged just a 2% return. That also happened about 5 times. Now, the majority of the time, 14 times out of 24, that's 60% of the time, the S&P 500 was up an average of 21%. If you're trying to guess what the market is going to do, the majority of the time, it's up big. The problem is when you're preparing and planning for your retirement, you don't get the opportunity to rely on what happens most of the time. You only get one shot at retirement. You get one shot to get it right, which is why you need to be prepared for all 3 market scenarios, up, down, or sideways. When you're investing for retirement, you still have a long term. When you're 62 years old, it's very likely that one of you, if you're in a couple, will live 25 or even 30 years. You need to have a good portion of your money invested for the long term. That's money that you can ignore the short-term ups and downs because you're relying on what happens most of the time in the market. But now you're retired. You also have a short term. You're worried about what might happen if the market goes down. When you're retired, you need money next week, next month, next year. You can't view your long-term money as long-term if you don't have the short-term money available to get you through the times when the market is down. Now, Warren Buffett said back in 2008, when the market was dropping during the great financial crisis, that if you need money in the next 5 years, you should put it in the bank. And if you need money more than 5 years from now, you should put it into the stock market. Now, your idea of short-term money and long-term money might not be exactly at the 5-year mark, and your idea of the market investments that are going up and down might not be 100% in the stock market, but the concept is right on. You should decide how long you want to protect your money by taking money out of the stock market. It's money that you have in case the market goes down. You should also decide how much risk you want to take in the market, money you have in case the market goes up. And remember to treat that money as long-term money. Keep it invested for the long term. Now, if the market turns out to be sideways in 2024, it didn't do much. Your investments didn't do much, and that's okay. It happened 20% of the time. Chances are, if the market's sideways this year, it's going to be up or down next year, so you still need to be prepared for the two options of the market going up or going down by having the right amount of short-term money and long-term money. Now, while it's good to keep an eye on your investments, when it comes to retirement, you have a lot more control over your time, your decisions, your activities. To learn how to get all you can from your money and your life, check out my next video where I share Bill Perkins' Die with Zero concept. I'll see you there.